Welcome to the Lighthouse Financial Advisors Money Over 50 podcast with Dallas Davison and Michael Hogue. This information is general in nature and does not take into account your objectives, financial situation or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Lighthouse Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50 with Dallas and Michael. Today's topic, why it's not as easy as just buying shares while they're cheap. Dallas, your topic.
Thanks, Michael.
And it's, I should point out, it's a point of a hot topic with you at the moment. We have touched on this in some other podcasts, haven't we?
Yeah.
Where we're talking about how we both saw each other for financial planning and then,
Well,
if that coincided with the time when the markets were down, you could buy in.
Yeah, exactly. So this is actually an idea that I had for a podcast. We were just talking this before we started recording about different ideas that we had while we were stuck at home. Investment markets were up, down, sideways. It's fairly chaotic, but we were stuck at home without anyone to sort of talk these things through with. So it was a good time to come up with here's a backlog of all these different topics.
Yes, because there is a saying, and it's something that we've both heard from more than one person over the years, is people say, I'll just wait until the markets drop by 40%. And then I'll invest then, or I'll wait till it gets to the bottom. And bottoms out.
Well, that's actually
it's probably even better. I'll wait till
people don't say I'll wait until it's dropped by 30%. I'll wait until shares are cheap, or I'll wait until the price drops. But no numbers are given. No. So and this is, like you say, this is relevant because Nick and I have just invested a bit. As you said, it lined up with when we had our planning meeting, we had a bit of cash that just became available. So, and we'll talk about that, and it's a good example of what happens there in reality. But so as you said, probably a good place to start is where this came from. Is we hear this all the time, and again, you can understand why. If that was the option, if you could just buy shares when they're cheap, well then obviously you'd do that because that would be fun.
Look, of course, if you could do it. And you could buy in right at the bottom or close to the bottom, then of course it makes sense to do that. So we're certainly not saying don't do that. I mean, the whole point of this podcast is to demonstrate how logistically it is very, very difficult for a number of reasons, for three main reasons. So the first reason.
So what we have seen a lot of the time is that when people, sometimes what they're talking about when they say, I'm just going to buy when shares are cheap, what they're doing in the meantime is rather than investing as they are saving money, as they have cash becoming available, people are just leaving that in a bank account, so sitting that on the sidelines. And this ties a bit into the podcast we did about keeping some powder dry. And there's a line between making sure that you've got enough cash as a bit of a buffer, and so you're not forced to sell anything at any point in time. And then what I think happens is in some cases people just keep saving cash and they're waiting for this moment when the market drops. And on average, what happens is that you miss out on more of a gain by the amount that you would have picked up if you'd been invested the whole way through. So if you were to save and just keep saving every fortnight as you've got cash available that you're saving, if you just kept saving that every fortnight and waiting for the market to drop, if in 3 years or 2 years or 5 years or whenever that drop does happen, what you find is that you probably feel pretty good in that moment. You feel like a genius because you go, yes, I've bought in at 30% down or 20% down or whatever that figure is. But you've actually missed out on the gain on the way through. So it's normally gone up by more than that before you've actually had that drop. So that's I guess number one, or how I think it is it's not really an option to. I mean, it's definitely an option. It's something you can do, but it's not something that we'd recommend is to try and save money and sit it on the sidelines and then try and buy in at that lower price.
Yes, certainly. And for most of our clients, when they come to see us for the first time, they're around that mid-50 years of age mark. They have, on average, 10 years to go. We split it up into paychecks or pay EFTs. Yeah, paycheck sounds better than pay EFT.
Yeah,
no one gets a check.
No one gets a yellow envelope with all their cash and everything.
But you essentially have 260 fortnightly paychecks remaining for the rest of your life.
Yeah.
So we say to people, look, the best time to invest is as you have that money come to you, which is every fortnight.
Yeah.
So you work out, okay, you need to put in, as a couple, $1,000 a fortnight, $800 a fortnight, and hey, we can do it this way and put it in your super fund, and we can claim, if not all of that, as a tax deduction, and the end most of that. So that's the best time, as opposed to parking that in the bank, which they could, that is an option. So they could actually save that money into the bank.
It's a really good visual to say there's 260 fortnights. So that first fortnight of savings, it's not indefinite. So if you park that in a bank account and then it takes 5 years for company prices to drop, you have missed out on 5 years off that growth. So you've only got 5 years remaining. So
look, and that's assuming for a minute as well that you can actually get in at the bottom as well, or close to the bottom. So no, I mean, no one knows. Yeah. No one knows when the bottom. If anyone tells you they know when the bottom's going to come or when it came. Don't walk, run. No one on earth can tell you that. Even Warren Buffett, the great man himself, cannot.
And that's a good, as we joked about at the start of this, but when people say, I'll just buy when they're cheap, relative to what? It's one of those things that it's never, again, if someone came and tapped me on the shoulder and said, hey, the share market has just bottomed, price is going to go up from here, fantastic. That would be what you do. But that's not, and we've talked about this at great length in podcasts over the last few months, that's not how it works. You don't know where you are in that squiggly line up and down. It's not a neat line down and then someone rings a bell and says, hey, it's the bottom now, you can get in. So, and that sort of ties into the next couple of points about why this doesn't really work. So the first one being, for most, especially for people sort of 50 and over, you've got a finite amount of time that you can be invested for. And or that you need to really focus on growing your retirement savings. If you're trying to sit on the sidelines and hold that money in cash, you are missing out on gains.
I mean, at the moment, the rate of return on cash is virtually 0%. It's virtually returning nothing. So it was a little bit of a different story during the global financial crisis. There was a period of time here in Australia where we weren't suffering as much as America, that's for sure, in terms of a recession. As a consequence, our interest rates in Australia were up around 6 or 7%. They were like in America and Europe, they were down at 1%. So what had happened there? A lot of people, I mean, they were content to actually sit their money in the bank account at that point in time because they're saying, okay, well, I get 6 or 7% rate of return. It was still the wrong thing to do because what happened is they missed out on
the return, on the bounce back.
But it was an easier decision for a lot of people getting that money. Different story in 2020. Interest rates in Australia are virtually 0%. They're 1%, and that, if you're lucky. So if you're sitting
about this in that podcast the other day, it almost makes it easier because you go, do you want a return? Do you want to be invested in companies and you are going to get a return over the long term, but it is going to be volatile, or do you want to sit your money in cash and get no return?
Yes,
and that's the question. So and for some of you, and as we talked about, for some of your money, you do need some money in the bank and get no return, and that's fine. That's a part of it. But for your retirement savings, for what you're trying to grow over the long term, you just can't afford to have that money sitting in cash and not get a return on it.
Yes, that's right. And without digressing too much, if you look at just even this last financial year that just ended on the 30th of June, so most higher growth strategies return about -1%, -2% for the full financial year. So if you'd sat your money in cash over that period of time and got 1% on it, you're really only over that financial year, 3% better off over that period of time. So it's not a great deal. people tend to measure the extreme, so they measure from February where the all-time high to to late March where it was it dropped by 37%. So people tend to measure extremes, but if you looked at it over from the 1st of July 2019 to the 30th of June 2020, the markets went up really, really strongly before they dropped. And then they partially recovered, so it was almost a flat year. So it wasn't that bad.
That's a really good example on a much shorter timescale than usual of what we're talking about. Is that if you were looking at this in July last year, so you're looking at this 12 months ago and going, I think company prices are a bit. I'm going to sit on the sidelines in cash. So you compare two people, someone who did that, and then you compare someone who just went, I'm just going to be invested, stay invested, and every fortnight as I have saved some money, I'm just going to invest that. They're really no better off, because this sort of ties into the next part of that.
And that's really just over 1 year too, which is a very short period of time.
Well, and that's sort of if you start to bring that out to, if you looked at this in January of last calendar year, so you look at 18 months ago, 2 years ago, 3 years ago, if you sat on cash that whole time waiting for that correction. Even if you did time that correction and you did go, yes, okay, I've waited till things have dropped and I've got into the bottom, you're still buying it at a higher price point than what you were looking at 2-3 years ago. So
that's right. So $0.2.
Point two, which is that when company prices are down, it's usually for a reason. So there's something. So and coronavirus has been the best example of this. Is that people talk about, okay, when share prices drop, I'm going to buy in. So if you'd said to someone 6 months ago, hey, why don't you buy some shares in NAB? And they said, no, I'm going to wait until NAB share prices drop from $28 to $14. You'd think, well, something's got to go badly wrong for those prices.
It hasn't dropped for no reason.
No.
Now usually it overshoots the mark, and it drops too far. Because you would argue that the value, which is the underlying worth of those companies, haven't halved when there's a 50% drop. What's happened is that there's been a bit more panic than normal, and that price has shot beyond that. But your point here is that that's usually on the back of a recession or a worldwide pandemic. Or
so when we were looking at this in March, most of our conversations with people were about, they were worried about losing their job, or they were worried about how long this downturn was going to go on for. They were worried about their business and whether they were going to be profitable over the next year, whether they're going to have to wind up, all those sorts of things. So when those exogenous factors come into play, people aren't sitting there going, oh, geez, asset prices are cheap. They're sitting there going, how am I going to pay my rent next week? They're more worried about, my income is at risk, whether that's due to recession, whether it's due to a pandemic, those sorts of things. So they're more worried about how am I going to pay the bills next month, next 6 months. It's not a time when people go, oh, well, I can just lash out and use every spare dollar I have to try and invest at the bottom of that at that time, because you don't know what's coming up over the next 6 months, over the next year. And so
that's absolutely the way it works out for people. So, I'm no psychologist, but just in the last 20 years I've observed that same thing. People say that, in fact, a lot of the times they struggle to put it into words, but they're thinking, okay, there's been layoffs at my company, or there's been, the person that used to sit next to me is no longer there, they're gone. I do have some cash here. However, I'm not worried about taking advantage of lower prices right now. I'm worried about my job. I'm worried about holding that cash. I'm worried about...
There's sort of two parts to this, and this is where there's sort of part 1, 2 and 3. And part 2 of this is even separate to the emotions, just logistically. Like if you are sitting there at work and you've got 6 months worth of your income saved in a bank account, and the guy who was sitting next to you has just been made redundant, well, like even logically, you shouldn't go and invest that money, because you might be next. So you probably do need all that money in cash.
Yeah, I mean, our advice at that point in time would probably be keep that cash, and revert back to your fortnightly pay and invest some of that every fortnight while you have the pay. And add it to your superannuation fund.
So where you get to then is that would be our advice, which would have been our advice 6 months before.
It would have been our advice 6 months before. Yeah, that's right.
So you kind of are going, even separate to the emotional side of it, logistically, it's not that easy. And then, so that's talking about if you've got cash sitting there on the sidelines, or if you have the ability to sort of get some cash. The separate part of that then is, and we talked about this a bit with the podcast about keeping some powder dry. Using debt is a bit of a different way that you can do that. But again, what happens is that in a big downturn, credit markets squeeze up a bit. Things get a bit harder. It's not as easy as I'll just go to the bank and borrow a heap of money, because banks are not lending a lot of money at that moment in time. That's even if you can get the money, there's normally a fair bit of chaos. There's normally a lot of lag time, and this is what you're talking about with our situation, where we actually went to borrow, set up an investment and borrow a bit against that. And so by the time we went to do that, put in the application, NAB, who we got the loan through, it took them, I think, 6 weeks to process that, because it was just absolute chaos, and they were having to deal with everyone else who had investments that were getting called back in and couldn't meet their repayments, all these sorts of things. So it's not as easy as just click your fingers and get the money.
It's true. So global financial crisis, banks just refused to lend. Yeah. So there was no lending unless you had something already approved and was sitting there. Yeah. Coronavirus. Yeah. Banks have actually moved people to different areas by the looks of things from internally. Yeah. Because obviously there's a big job that they have in terms of people that have put their loans on their loan repayments on hold and things like that. So again, logistically, it's even if it's conceptually a lay down is there that you're going to be able to borrow some money and take advantage of investing with that borrowed money in this instance. I mean, and people do that all the time with houses, don't they? And they do it like they say, okay, I can get this house. Yeah. I can get it for 300. It's worth 400. We'll borrow to do that. So it's the same. It's the same concept here. Yeah. It's just logistically, it's hard to get that. Yeah. It's hard to get that.
Well, it is, and the same thing applies with. I guess if you use the analogy of property, because what we're talking about here is the same thing applies with every asset. So it's not just about shares, but there's something about. Because shares are, company prices are so liquid, and you can Google a NAB share price every half an hour, and so, but this applies to every asset. So you could be saying, we want to change our warehouse, for example, we want to upsize and get a bigger place. We're going to wait until the market drops. Well, what's actually going to happen is, in the middle of coronavirus, if you had been sitting there going, well, we want to change over, we want to buy this bigger house because we think prices have dropped a bit. It's not as easy as that, because your bank that you've got to go and get the loan from to go and upgrade your house, they're just not lending at that moment. They're more focused on their existing lending and are you going to be able to keep paying your existing mortgage? Yeah. They're really not looking to throw more money out at that moment.
That's right.
So, so that's, I guess, point 2 is the logistics of that. Whether it's when you do have cash in the bank, or if you were going to go and try and apply for a loan, it's very hard to actually make that happen at a moment in time when you really need to be hoarding a bit of cash, not knowing what your income's going to look like over the next 6 months.
That's right. So the topic again, why it's not as easy as just buying shares while they're cheap. Point 3, Dallas.
So this ties into, and it's point 2 and point 3 are interlinked really, which is that even if you did have access to cash, even if you'd managed to somehow get a hold of this cash at a moment in time when you weren't missing out on any gains on the way through, even if you knew that your income was reliable and you could invest that money, or if you did have that loan already approved, or whatever it was, however you were going to be able to invest that money, it's very hard emotionally. So separate to the logistics, separate to intellectually whether you know you should do that, it is emotionally an extremely hard thing for people to do in that moment.
It is, and I don't know if it's... So the market's dropped by 20%, and I don't know why it's hard for people to invest at that point in time. I think it's a little bit of, I'm scared that it's going to drop further, or and I'm scared that that I'll buy in, even though it's 20% down. Yeah. I'm scared that my whatever I've invested in there will be worth less because it's dropped to 40% or 50%. So I think it's a bit of fear there, and then I think it's a bit of fear of actually missing out on the absolute bottom, which we just tell people to forget about, because
it's a bit of fear of loss, and it's a bit of bit of fear of loss, and it's a bit of fear of missing out. Where you go, so if you've done all this and you go, oh, this is a fantastic opportunity, you either are scared that you're going to lose money, and when we say lose money, you're scared that you're going to buy in at a 20% drop, and then the market's going to continue to fall. So you're scared about losing out on that. Or even if you are looking at it over long term and going, well, I can buy in at a 20% discount, the greed factor almost ties in where you go, well, I want it to drop further and get in at the absolute bottom and really squeeze every dollar that I can out of that. So it's, and because we've just lived through that again, it's really interesting to see that, to have seen that play out where when it becomes almost, when prices are down, people get less and less optimistic as prices go down. They do, So when prices had dropped by 15%, you had people going, and again, because it all ties into what's actually happening in the real world, which is when, there's this new pandemic and there's new virus, and so share prices dropped by 15%. There was probably more talk about people going, oh, is now a good time to get in? Should I've got $10,000 in a bank account, should I put that into my super fund, or should I do something about that? As you saw that come down more and more, once it got to 20%, 25, 30, 35%, there was less and less talk of, hey, I've got this money I want to throw in, I want to invest. And there was more talk about, is the world ending?
It's a really good point. You would think conceptually that it would become far more attractive for people to buy in as the price went through those 20, 30, 40, in the global financial crisis, 57%. But people actually, the further it drops, people actually do become convinced the world is going to end. It's never going to be the same again. I mean, there was ridiculous stuff getting around the global financial crisis, like, this is the end of capitalism. And people believed it. And for a moment there, I actually, because I was just brain, I had to stop and think. It took me about 2 seconds to realise it was rubbish. But that's the sort of stuff that gets thrown around at that point in time, and people start to go, "Gee, is this true? Is this, is everything going to be nationalised? Is it going to be?" It's crazy when you step out of that and go, "Okay, well, that's ridiculous." And when things recover, as they always do, if you're well and truly diversified, then it seems crazy to think that. But it's true. Like, the further it drops away, it just becomes so emotionally hard for people to buy at that point in time.
It is, and I think that the point of a lot of our planning is not to try and this is why we just don't play this game, because you get, rather than trying to convince people to invest at a certain price point, our attitude is really just to go, okay, you've got 260 fortnights left. You've got $1,000 spare this fortnight. That money should just be invested straight away. It doesn't, to some degree, it doesn't matter what that price is, because next fortnight you'll have another $1,000 and you're just going to invest at that price. So if the price is down, great, you're going to accumulate more shares next fortnight. If the price goes up, okay, well, the shares that you bought this week, this fortnight, they've gone up in value.
Yeah, and look, we're the first to put our hands up and say we have no idea what the price is doing at any given point in time. Look, we're in good company there, because
the only difference is we know. The difference is we know we don't know that.
We don't. Warren Buffett himself would put his hand up and say that. There's other people like Nick Murray that would say the same thing. What it is though, like, I mean, if you look at the price of anything, it's set by buyers and sellers. And when there's a normal, I guess, equilibrium, the price is fairly constant, because buyers and sellers work out the value of these companies is about this, and you'll see the price go up or down. Is when there's panic, what you're finding is that all of that logic gets thrown out the window for a period of time. So look, it's very hard to predict irrationality. So you're seeing the price come down because there's more sellers that wake up and list their shares for sale. Now you would say, who's doing this? Well, it's as simple as actually calling your superannuation fund and saying, change my investment strategy. This is
I was just about to
this
talk
is
about this.
what's happened. I've just lost $100,000. So
that's
people are
exactly
actually
what we found is, if you remember at the very bottom of the drop so far, as we keep saying, we got an email from Sunsuper saying, hey, if you're trying to transact on a client's account, or if you need anything done, just letting you know that our admin turnaround times are through the roof. Because there is just so many people that were contacting them at that point in time. So that's exactly what you're talking about there, where when prices have dropped by 10%, no one pays any attention. When they drop by 40%, people weren't ringing Sunsuper saying, hey, you beauty, this is company prices are on sale now. I'm gonna put more money into my super. They were panicking, saying, we've got to get out. I just want to stop the pain somehow.
Yeah. So what you found is that someone who had $500,000 in their super fund, they watched that drop really, really quickly too. So it was in less than a month. The next time they logged on, it was at $375,000. They panicked. They called Sunsuper or QSuper or whoever they were with and said, just get me out, just get me into cash. Now, what happens at that point in time is that there is a trader or a bunch of traders that work for those super funds. They actually have to go to the market, it's the share market, and they say, I've got to sell these $375,000 worth of shares. Who's offering? Now, no one's buying at that point in time. Like buyers are sitting on the sidelines. So what you have is the price drop again, because when you've got a mismatch between buyers and sellers, then you've got more sellers, you've got less buyers. For every 100 people trying to sell, you've got 10 people wanting to buy. The price comes down a bit further, so more buyers become interested. They buy. The next day it happens all over again. Now, what you get at some stage, you get the last person was going to panic has panicked.
The pessimism.
Really. And the peak of pessimism. So anyone who was going to make those changes to their super fund and get out because they're panicking, they have already done that. And what happens then is you start to see the price rise. Now, if you were thinking of changing your investment strategy because the price was dropping and you see the price start to rise, what happens is your mind's at ease because you can see the price is coming up again. You have all these other potential buyers that have been sitting on the sidelines waiting for the bottom, and they start coming in then and buying up. So you get the mismatch the other way. So that's what causes the price to rise. So you get 100 people wanting to buy for only 10 people wanting to sell. So the price has got nowhere to go but up. Now, in all of that though, it's like a sawtooth because it doesn't just drop down in a V. There's many rallies. No one knows if that's going to be a permanent rally. So you get a price drop of 20% and then it rallies by 5%. Now, not one person on earth can tell you whether that 5% rise there is a dead cat bounce.
I love that.
All right, so geez, we heard some animals on this podcast. You were talking about skinning a cat the other day, and now we're talking about a dead cat bouncing. And we are actually animal lovers, so there's no animals were harmed during this podcast. So you get people,
and I think if you break that down into people's super balance, even so, if you've got $500,000 in super, and you have some cash sitting on the sidelines, so you've got $150,000 cash that you've saved. Further to point one, you probably would have been better off investing that the whole way through and just picking up the gains on that. But if you've got $500,000 in super and you've got $150,000 that you've painstakingly saved over 150 fortnights, you're just going to, and then your $500,000 super balance drops to $400,000. You've watched that happen. Now, I guarantee you that no one at that point in time goes, oh, this is great, I'm going to take $100,000 out of my savings, I'm going to dump it into super just to get me back to feeling. You'll feel like you're only just getting back to where you were. It feels like a waste of that $100,000. So no one's investing at that point in time. Then what happens is things pick back up by 5%. So your 500 drops to 400, goes to 420,000. And people go, oh, this is it. This is the rally. This is when I am going to put. So they put $50,000 in.
Yep.
And then the 420 they've put 50 in, it drops again, and their balance goes back to 400,000. So this is what happens is, as we said, it's a sawtooth both in terms of prices and it's a sawtooth in terms of emotion. So people are going, well, my 500,000, then it turned into 400,000. Then I put some money in, and now it's back to 400,000. So not only have I lost the 100, I've lost the 50 that I put in.
Yeah, and look, superannuation funds have got I guess they need to report better.
Yeah.
So I've always thought they should report the number of shares that you hold or the number of units you hold. They don't. They report the balance.
Yeah.
So if you could actually see that your share numbers or your unit holdings were going up, even while the overall dollar value was coming backwards, that would appease a lot more people, I believe, if that was reported before the dollar balance. The unit balance should be reported, but they don't.
No.
I mean, so people can be forgiven for saying, I've put an extra $50,000 in it. It's disappeared. So it's gone to zero. So why would you do that?
And so
what's actually happened? They've actually bought $50,000 worth more shares. The unit balance has gone up by a lot. It's just that the share price has come down further to seemingly make it look like that money's disappeared, which is wrong.
And that's kind of what I say is that third point is, even if you'd somehow got all this right and you had the cash on the sidelines and you went to put, and as that market drops, when do you pull that trigger? And I think that you're kidding yourself if you think that, unless you are actually Dr. Spock and you can just put that money in and just never look at it again. The reality is what happens is people, it's always waiting for tomorrow, wait to see what the price does. So, and even if you could emotionally work through that, no one's going to tell you when the bottom of the market is anyway.
No.
There's no one rings the bell. So
no, there's no one on earth that can tell you that, because it's an irrational thing. So the price is getting pushed down by the buyers and sellers. No one knows when that's going to end and start to recover. It's only well into the future where you can look back and say, okay, that was the bottom, because it's fully recovered now. So look, it's really, really difficult to do. Without stealing your thunder here, so is there a wrap up that you have in terms of saying, why don't we? I mean, our advice to our clients is to. And I think the underlying theme behind this podcast is pick a strategy and stick to it.
Have a plan.
Have a plan, and a plan. It brings simplicity and normalcy to extreme events. So you're basically saying, okay, we've got 260 fortnights for a lot of people. We know we can take some low hanging fruit here. We can put $1,000 a fortnight in between the two of you, and we do that for 260 fortnights. We know that we can claim those as a tax deduction. We know that you'll buy in sometimes when the price is higher, sometimes when it's lower, sometimes when it's really low. You're going to average out. You're investing when the money becomes available, which is every fortnight, and that sticking to the plan. I mean, we didn't. Again, without digressing too much, we spent the last 10 years telling our clients there will be a drop of 30 or 40%, and they've looked at us like we have two heads, because for 10 years,
we're like the boy who cried wolf.
For 10 years, there was just no drop at all, and then so during this period of time, a lot of our clients have said, "Oh yeah, this is what you're talking about, isn't it?" So they haven't paid, because we've been telling them in good times that it's going to happen, but there have been a few people where we've just had to say, look, let's go back to the plan. We wouldn't say hold off that money, stop your salary sacrifice, anything like that. We'd say just keep going with that, keep going with that.
And that's I think, to me, the two parts to it is, the way that I'd wrap it up is that both from a logistical point of view and from an emotional point of view, you have to have a plan. So you have to, that is our job, is to sit there and go, okay, 10 years out, this is the plan, this is what we're working towards. Now, things do happen that are outside of your control, especially when there is these big external events, you might lose your job, your income might drop, something else might happen. But if you've got a plan, that at least takes away a lot of that decision making on the way through. You don't even have to think about, are shares cheap or are shares not cheap? It just doesn't matter, because you go, my plan consists of buying every fortnight, or it consists of buying it every month, or whatever that is. You just go, I don't have to think about that price at all. You can then just focus on, okay, what do I need to do to make sure that I'm going to be able to keep my job, I'm going to be able to keep everything ticking along as it is. It's just one less thing to worry about or to think about, is trying to get that right under conditions of extreme pressure. So I just think it's not a game that I want to play. It's not a game that I recommend for any of my clients.
Good point to wrap up. Thanks for listening.
Thank you for listening to the Money Over 50 podcast with Lighthouse Financial Advisors. We look forward to catching up again soon.